intelligent investors are flocking towards covered bonds more than ever before. Wondering what makes a covered bond a one of its kind investment instrument and why this can be your next best investment bet? Well, we are here to simplify that concept for you. In the following sections of this video, you will understand more about covered bonds. Indian investors generally invest in two types of financial instruments: equity and debt. Equity is considered riskier than debt, and hence, risk-averse investors prefer debt more. However, the typical perception among investors is that debt instruments provide lesser returns than equities. The only exception being bonds, because traditionally bonds have yielded higher returns than conventional debt instruments. But when Yes Bank and Lakshmi Vilas Bank collapsed, the investors got nothing, exposing them to the absolute truth of high yield bonds. When high yield bonds mature, you get a substantial amount of money. However, if the company defaults, you can lose all your capital. Covered bonds offer an alternative to this. What are covered bonds? A covered bond is a bankruptcy remote or bankruptcy protected structure that allows you to get pretty good returns. Bankruptcy remote or protected means that even if the NBFC or the issuer goes bankrupt, the investors still have a very high probability of recovering their investment amount from the cover pool that is given by the issuer. This is a significant reason why these bonds provide similar returns to any other bonds, but your risk profile is comparatively lower when compared to regular bonds. Let us now understand covered bonds with a simple example. Suppose you run a gold loan company. You started this business with 1 crore capital. Within 15 days, you found 10 borrowers and distributed 1 crore amongst them with their physical gold. Now, on the 16th day, you got 3 new borrowers willing to take gold loans from you. But since you've used up your entire capital, you do not have money to give them loans. In such a situation, you can borrow money from a lender, per se Wint Wealth in this case, and these gold loans can be pledged as collateral to them. Also, you must note that there is no physical transfer of assets in covered bonds. Now that you know what a covered bond is, let us understand what are the regulations laid down by SEBI or Securities and Exchange Board of India to protect the investors' interests. While the Legislative Assembly of India is yet to pass a specific law governing covered bonds in India, it does not mean that the sector is completely unregulated or ungoverned. The issuer of covered bonds and the investors get into a contractual agreement under the general law pertaining to investments in India. Generally, covered bonds come under the purview of the Contract Act of 1872. As per SEBI regulations, listed bond issuers have to prepare a document providing exhaustive details about the company, its management, its operations, and the financial positions. It must also mention about the potential risks involved and the features of the bond issued. Moreover, the issuers of these bonds declared the risks, credit, fraud, and liquidity risks in advance for the investors to take an informed decision. The bond is also required to have a unique code called the International Securities Identification Number or ISIN and is assigned a script code by the time of listing. The investors are suggested to check the script code and the ISIN before investing. Next, we will be talking about which factors led to the rise of covered bonds. Investing in covered bonds is a relatively new concept in India. With companies like Wint Wealth opening the sector for retail investors, we can only expect an upswing from here. While the history of covered bonds in Europe dates back to 1769, which is, I guess, almost around 250 years ago, the concept came in India in just 2012. Initially, National Housing Bank created a working group for promoting covered bonds in housing finance. However, the effort was largely a failure and was put in the back burner due to the lack of demand. Finally, in 2019, covered bonds was revived with collateral backed by vehicle loans. But not too many NBFCs offered this type of covered bonds for retail investors. The following section will talk about why Wint Wealth is a category creator and how we can help you fulfill your financial goals faster. Wint Wealth is the only platform in India to offer covered bonds to investors and help them earn 9 to 11% returns per annum. You can visit the Wint Wealth website, complete the KYC, find an open scheme, click on the Invest Now button, and done. investing in covered bonds have never been simpler before. Summing up the discussion, Indian market has just opened up for covered bonds, and the coming days will decide the trend. Going by the recent numbers, we can safely assume that the early adopters will be the biggest gainers. Now, investors can invest in covered bonds through public issues. Think of this as an IPO for debt instruments. And to top it off, there is no minimum investment amount. This is the government's initiative to open up the debt markets for India. Anyways, that is all for today. Please like, share, and subscribe to our channel to know more about what's happening in the world of finance. Thank you.